Well, hello. Today we're going to have a conversation about how does monetary policy affect the economy. Alright, now monetary policy is conducted by the Federal Reserve, which we like to call the Fed in the United States. The Fed has the ability to change the amount of money in the system. Now they use three tools of monetary policy. Now the three basic tools of monetary policy are: one, open market operations; two, they can change something called the discount rate; or three, they can change something called the reserve ratio. Now, changing the tools of monetary policy affects economic activity, and it changes something called the money market. So, let's kind of go over the three tools and what do they normally do. So, over here we're going to have the money market. Now the money market is basically, we have our money supply, we have our money demand, we have our equilibrium level of interest rates, and we have our quantity of money in the system. Alright? Then that affects economic activity. So over here, let's put the economy. In here we have our price level, we have our real GDP level, we have our short-run aggregate supply line, and our aggregate demand line. Alright, now to understand how you conduct monetary policy, you need to put yourself in a particular situation. So let's say that the situation is we are faced with a recession. Now during a recession, you're going to have an increase in the level of unemployment. An increase in the level of unemployment is going to trigger one of the things that the Federal Reserve is supposed to be doing for us. They have a dual mandate. Mandate number one is price stability. Mandate number two is high employment. An increase in the level of unemployment is going to make the Federal Reserve try to work on that employment mandate. Now, what they basically want to do is they want to make sure that the money supply shifts to the right so that interest rates go down. How do they do that? Well, they perform what we call open market operation purchases. They would lower the discount rate, and they will lower the reserve ratio. Now this behavior by the Federal Reserve makes the money supply shift to the right, and as the money supply shifts to the right, interest rates decline in the economy. As interest rates decline in the economy, it makes businesses and people more likely to borrow money. So you're going to see an increase in the level of consumption, an increase in the level of investment, and an increase in the level of net exports. As that happens, the aggregate demand tends to shift to the right. And as the aggregate demand shifts to the right, economic activity picks up. Now real GDP tends to increase, which is what they wanted here because we're having a recession. And remember, a recession, it's a decrease in real GDP. So as real GDP is decreasing because of the recessionary behavior, then the Federal Reserve is trying to push that real GDP in the opposite direction, basically. So as real GDP is shifting less, we're trying to move it to the right by expanding the economy. So real GDP will tend to go up after the Fed is doing with their monetary policy. But another thing is prices tend to go up as well. So this policy tends to be inflationary at the end. And that is how monetary policy stimulates the economy. Alright? I hope you learned a lot today. And thank you for tuning in to Professor Choi. Have a good one.